So if you've glanced at any market chart recently, you've probably seen it. Just a sea of red. From tech stocks to Bitcoin, it feels like everything is taking a nosedive, and it's leaving a lot of us just scratching our heads. Okay, let's get into it and figure out what on earth is going on.
This is it. This is the single biggest question on every investor's mind right now. Is this a crypto thing, a stock market thing, or is there some single powerful force that's dragging both of them down together? Well, that's what we're here to do. We're going to connect those dots.
And just to really set the stage for how serious this is, just look at this number. In just a few weeks, Bitcoin, the bellwether for the entire crypto market, has plunged by about 25% from its recent highs. This isn't just a little dip, folks. This is a major correction.
The answer to that big question really starts with one core concept. This isn't just a crypto problem or a stock problem. It's what the pros call a risk-off storm, and it's hitting all the most speculative corners of the market at the exact same time.
So, what in the world is risk-off? Honestly, think of it like a financial weather forecast. When the forecast is sunny and clear, investors are feeling good. They're happy to take risks. But when the storm clouds start gathering, they get scared. They run for shelter. And that means selling their riskiest assets first. Well, right now, the forecast is definitely stormy.
And this particular storm is really being driven by four huge forces. First, you've got a valuation shock, especially with investors getting worried that the whole AI boom has just gone too far too fast. Second, market liquidity is fading. Basically, there's less cash sloshing around to buy up assets. Third, and this is a big one, we're seeing this cascading deleveraging, which is a nasty domino effect of forced selling. And finally, there's just a ton of uncertainty about everything from interest rates to geopolitics, and that's making everybody super nervous.
Okay, so we have this big risk-off storm. But how exactly does a shock in the tech world create a flash flood over in crypto? Well, the link is actually way more direct than you might think. Let's break down how that domino effect really works.
It's really a simple three-step chain reaction. Step 1. The same people, we're talking big hedge funds, institutions, and even regular traders like us, they own both tech stocks and crypto. So step 2, when they get spooked by something, say falling AI stocks, they don't just sell their stocks. No, they rebalance their entire portfolio, which means selling crypto too. And that leads to step 3. Selling pressure in one market spills directly over and creates pressure in the other. It's pure contagion.
But as we've already seen, while both markets are down, the crypto world is going through something way more dramatic. This isn't just a storm over there, it's a full-blown meltdown.
And this chart right here really puts the sheer scale of this into perspective. A 10% drop in the NASDAQ, that's definitely painful for sure, but it kind of pales in comparison to the 25% nosedive we've seen in Bitcoin. So the big question is, why the huge difference?
A huge part of the answer is captured in this one phrase. You see, the crypto market is built on a mountain of borrowed money, or what we call leverage. The best way to think about it is like a game of Jenga, but one built with borrowed blocks. When the market dips even a little, traders get margin calls, which forces them to sell their crypto to pay back loans. This forced selling pushes prices down even more, which, you guessed it, triggers more forced selling. It's a truly vicious downward spiral.
And the cost of this whole cascade has been absolutely staggering. In just the last few weeks, over $1 trillion in value has been wiped clean from the total crypto market cap. $1 trillion. Just gone.
Now, to understand why crypto is so fragile, you kind of have to remember the deep scars left over from 2022. The collapse of Luna, which was then followed by these huge firms like Celsius and Three Arrows Capital just going bankrupt, it created this massive crisis of confidence. And that trauma, it never really fully healed. It left the whole system brittle and extremely vulnerable to the kind of risk-off shock we're seeing play out today.
All right, let's pivot for a second and zoom out into the stock market, because while it's definitely connected to crypto, it's also dealing with its own unique set of fundamental problems that are causing this downturn.
Stocks are facing what you might call a wall of worry. The biggest headache? The Federal Reserve's ongoing battle with inflation. That means higher interest rates, which then sparks fears of an economic slowdown. On top of that, you have companies dealing with rising costs across the board, and all the global uncertainty right now certainly isn't helping anyone's confidence.
Now, this slide is so important because it explains exactly why tech stocks are getting hit so much harder. You see, high-growth companies are valued based on profits that are expected way out in the future. When interest rates go up, the value of those future dollars goes down a lot. It's a concept called valuation compression, and it's the reason the tech-heavy NASDAQ falls so much faster and harder than the broader market.
And if we dig even deeper into the tech sector itself, there are two specific fears causing this sell-off. First, there's this growing anxiety that maybe, just maybe, the excitement around AI has created a bit of a valuation bubble. And second, the market has become dangerously reliant on just a handful of megastocks, the Magnificent Seven. So when those giants start to fall, they take the entire market down with them.
So, we've unpacked all the reasons for this big cool down in both markets. Now let's stop looking at the past and start looking toward the future. Think of this as your guide for what to watch to get a sense of where things might be headed from here.
These are the 4 key signals you need to monitor. First, watch the money flows into crypto ETFs. Is that big institutional money coming back? Second, keep a close eye on the upcoming earnings reports from big tech. Do they justify these massive valuations? Third, watch the data on forced liquidations in crypto. Is that deleveraging cascade finally slowing down? And last but not least, of course, all eyes are on the Fed and inflation data. That's what will set the tone for pretty much everything.
And that leaves us with the ultimate question, doesn't it? Are we just watching a temporary, maybe even healthy correction after a huge run-up, or are the fundamental links between these markets and all the pressures on them signaling the start of a brand new, much more volatile reality for all of us? I guess only time will tell.